Let's talk about something that will change the way you look at your investment forever. A reality check so stark it might feel like a gut punch, but it's the one piece of intelligence you cannot afford to ignore. If you're holding IRAQI dinar or Vietnamese dong, you've been fed a steady diet of hope and, soon, for years, the whispers of a 6-day window, a secret RV date, a global reset that will make you rich overnight. I'm here to tell you that focusing solely on Baghdad or Hanoi is like watching the wrong screen during a heist movie. You're missing the real action that dictates everything. The truth is, the most critical, explosive pressure right now isn't coming from the central bank of Iraq statements. It's radiating from the frantic trading floors of Mumbai and the tense policy meetings in Hanoi. And it's creating a perfect storm that makes the fantasy of an isolated, miraculous revaluation not just unlikely, but nearly impossible in the current global climate. This is the real 6-day window you should be watching, a countdown to potential breaking points in a worldwide currency crisis. Let's start with India, a powerhouse economy. The Indian rupee isn't just weakening, it's in a state of controlled emergency. It recently hit an all-time low, breaching 90 against the dollar. But here's the twist that mainstream Forex analysis often underplays. This isn't passive decline. This is a frantic, multi-front defense by the Reserve Bank of India that looks more like a military operation than monetary policy. Reliable financial correspondents have detailed how the RBI operates from dedicated dealing rooms, issuing orders to sell dollars in precise, non-rounded figures like $132 million to avoid market pattern detection. At the peak of the pressure, they've been instructed to sell a staggering $100 million every minute to try and hold the line. They use unmonitored phone lines and can halt all activity without warning to create chaos and deter speculators. This is a central bank fighting for its life. Now, why should a dinar holder in Texas or a dong investor in California care about the rupee? Because it's the canary in the coal mine for every emerging and frontier market currency. If a $1 trillion economy with massive foreign reserves and a sophisticated central bank is resorting to these extreme, cloak-and-dagger tactics just to slow its fall, what chance does a currency like the dinar, from a nation still rebuilding from conflict, have to suddenly strengthen against that same almighty dollar? It sets a devastating precedent. It tells you the gravitational pull of the strong US dollar, fueled by Federal Reserve policy and global safe haven demand, is overpowering everything in its path. Now, let's pivot to Vietnam, because the story of the dong is even more seductive and, therefore, more dangerous for investors. The surface-level narrative is pure gold. Vietnam is an economic superstar. Its stock market was one of the world's top performers. FDI is flooding in, and it's a global manufacturing hub. This boomtown story is what fuels the dong investment thesis. But the twist is in the exchange rate data, and it's a glaring contradiction. Despite this phenomenal economic growth, the Vietnamese dong has consistently weakened against the dollar. The State Bank of Vietnam has had to steadily widen the trading band, allowing for more depreciation. And the most critical red flag, visible to anyone who analyzes on-the-ground financial reports, is the black market premium. Right now, the difference between the official bank rate and the street rate for dollars in Vietnam is at a multi-year high, sometimes exceeding 5%. This gap is a screaming alarm siren. It means the official rate is an artificial construct, propped up by central bank intervention, while the true market price, driven by citizens and businesses seeking safety in dollars, tells a story of deep-seated distrust in the local currency. The central bank is caught in a brutal trap. To fuel growth, it needs low interest rates. To defend the dong and curb the black market, it needs high rates. It's trying to do both, and is slowly depleting its foreign exchange reserves in the process. So, you have a tale of two economies, one in a shooting war for its currency, and another masking severe devaluation pressures with a glittering growth story. This is the brutal, data-backed reality of the global currency battlefield in 2024. This is the environment into which hopefuls are waiting for the Iraqi dinar to suddenly soar. It's not about the sincerity of any guru or the parsing of an Iraqi minister's speech. It's about physics. When a hurricane is ravaging the entire coastline, you don't expect one small, fragile house to quietly appreciate in value. You expect it to struggle to not get swept away. The first lesson is this: stop listening for echoes in Baghdad and start feeling the tremors from Mumbai and Hanoi. Your investment's fate is being decided there first. Now, let's bring the story home to the very investment you're holding and see what this global storm means for the Iraqi dinar itself. If you think the pressure on India and Vietnam is intense, wait until you see what it's doing to a currency with one foot still in conflict and an economy walking a tightrope. The shocking truth is, the stable, official rate of around 1,310 dinars to the dollar you see online is a carefully managed illusion, a facade propped up by the Central Bank of Iraq to prevent total economic chaos. But behind that official curtain, in the unsupervised markets where real supply and demand meet panic and necessity, the dinar is already trading at a massive 15% discount. That's not a prediction. That's a present-day fact on the streets. This gap is your first, undeniable red flag that something is deeply wrong. And here's the twist that dismantles the entire RV, or revaluation fantasy. The Central Bank of Iraq is not planning a magical increase in your dinar's value. On the contrary, a growing number of economists and officials within Iraq are now openly discussing the necessity of doing the exact opposite, potentially floating the currency or even officially devaluing it further. Why? Because the country is staring into a financial abyss. A senior economic expert, Mana Al-Abadi, has just sounded a dire public warning. He reports that by August 2025, Iraq was already running a crushing monthly deficit of 10 trillion dinars, on track to explode past 15 trillion by year's end. Where is the money going? A staggering 73 trillion dinars of August spending was purely operational, meaning it's funding a bloated government payroll, subsidies, and welfare programs riddled with what he calls ghost employees and significant leakages. This isn't gross spending. This is a leaky bucket draining the treasury dry. And here's where the global pressure from paragraph 1 slams directly into Iraq's fragile system. To pay for these unsustainable domestic costs, Iraq must sell its oil for dollars. But with oil prices volatile, the government then forces the central bank to buy those dollars from the Ministry of Finance and sell them at a subsidized rate to importers and citizens through a currency auction. This auction is now a hemorrhage. In just the first 9 months of 2025, the central bank sold over $60 billion, but only took in $49 billion, forcing it to plug the $11 billion hole by raiding its own precious foreign exchange reserves. These reserves, once a robust $95 billion, are now being actively drained to maintain the peg, not to strengthen it. Think about that. The very buffer that's supposed to protect the dinar's value is being liquidated just to keep the lights on at the current artificial exchange rate. This is a countdown. Every dollar pulled from reserves to feed this system is one less dollar available to defend the peg against the next shock. And the shocks are lining up. The U.S. Federal Reserve, concerned about dollar smuggling and money laundering, has already placed heavy restrictions on dollar transfers to Iraqi banks, rejecting transactions and creating a severe liquidity crunch. At the same time, a terrifying domino effect of currency collapse is rippling through all of Iraq's neighbors, from Turkey to Iran to Syria, depressing the value of every currency in the region and increasing the pressure on the dinar to follow suit. This is the real 6-day window. It's not a countdown to profit, but a countdown to a potential breaking point. The moment global oil prices dip again, or a political crisis hits, or those dwindling reserves hit a critical low, the central bank may face an impossible choice: continue a doomed defense and watch reserves vaporize, or step aside and let the dinar find its true, much lower, market value. The so-called revaluation community is waiting for a miracle that requires the entire global financial system to reverse its laws of gravity. What the cold, hard data shows is a currency caught in a vice, with internal deficits gnawing at its foundation and external storms battering its walls. Your investment isn't in a vault awaiting activation. It's on the front line of a quiet economic emergency. So, we've pulled back the curtain on the central bank's frantic defense of the dinar's peg and the grim economic math of Iraq's fiscal crisis. Now, the question is, where do you, the holder of this currency, go from here? The shocking twist is this: the very structure of the currency market and the profit-hungry ecosystem that has grown around it is designed to ensure that the individual investor loses money. Let's follow the money for a moment. You've likely purchased your dinars not on a regulated Forex trading floor, but through a currency dealer who specializes in exotic notes. These dealers typically charge a premium of 30% or even more above the official rate. This is the first unbridgeable trap. Even if the official rate were to miraculously move from 1,310 to 1,200 dinars to the dollar, a significant 8% revaluation, you would still have lost over 20% of your investment because you paid a premium to buy in. The dealer already locked in their profit the moment you sent your cash. But the trap is deeper than just the buy-in premium. This entire investment thesis is based on a fundamental misunderstanding of what a currency revaluation is. It is not a lottery ticket handed out to foreign speculators. It is an emergency monetary policy tool used by a sovereign government and its central bank to manage its economy in times of extreme stress. We saw this in 2020 when the Central Bank of Iraq devalued the dinar by 22.7% to shore up government finances, and again in 2023 when it was partially revalued as oil prices recovered. These are not windfalls. They are macroeconomic shock absorbers with profound consequences for Iraqi citizens, like skyrocketing inflation and eroded purchasing power. The people cheering for a massive revaluation are, often unknowingly, cheering for the economic immolation of an entire nation, a reality that makes such a drastic, politically suicidal move almost impossible for any rational government to undertake. The data from the mainstream, regulated financial world tells a consistent and unexciting story of absolute stability. As of today, December 10, 2025, the dinar trades at 1,309.97 to the dollar. Over the past month, it is unchanged. Over the past year, it has moved a mere 0.07%. Major Forex platforms like Say and Investing.com show a mid-market rate locked between 1,310 and 1,312. The so-called 6-day exchange window is not visible anywhere on these legitimate trading screens. The silence from the actual markets is deafening. This is the hard data that the revaluation rumors and hopeful YouTube videos must answer for. Where is the volatility? Where is the massive buying pressure from global banks? It doesn't exist because the dinar is not a liquid, freely traded Forex pair in the way the euro or yen is. It is an exotic currency with very low liquidity, which means you cannot easily sell large quantities, and the spread between the price you buy and the price you sell is enormous. This illiquidity is what allows the fantasy to persist in a vacuum, away from the price discovery mechanisms of the real global market. And this brings us to the most painful analysis of all: opportunity cost. Think about the capital you have tied up in this paper. What could that money have done over the last 5 or 10 years in a simple, broad market index fund, in a savings account with compound interest, or even in another, more transparent emerging market. The cost of waiting is not zero. It is the compound growth you have missed out on, chasing a mirage while real wealth was being built elsewhere through patience and data-driven strategy. This is the moment of truth. Your investment journey didn't start in Iraq. It started with a story sold to you. A story of instant wealth, of beating the system, of inside knowledge. But you've watched these past minutes, and you now have the evidence that contradicts that story. You've seen the currency peg under siege, the reserves being drained, the government struggling to pay salaries, and the official exchange rate in a state of perfect, dead calm. Two realities cannot exist at once. One of them is a fantasy. The most powerful thing you can do right now is not to find another guru who tells you next week, but to act on the information you now possess. I want you to do something right after this video ends. Take out your phone, open your Notes app, and do this 3-step audit. First, write down the exact amount you paid per dinar, including all fees. Second, go to a legitimate source like IRAQI.com or tradingeconomics.com and write down the current official mid-market rate of 1,310. Third, and this is the crucial step, calculate the percentage loss you would take if you sold at that official rate today. Seeing that negative number in black and white changes everything. It transforms hope into a quantifiable financial reality. Then, head down to the comments. I want you to write one word that describes how the calculation made you feel. Was it shocked? Disappointed? Enlightened? Let's build a community of people who are ready to move forward based on facts, not fairy tales. Your financial future is too important to leave in the hands of rumors. Take back control, starting with that simple 3-step audit. Do it now.